Okay, good day everyone. Welcome to Stock Investing 360. Today we're going to talk about five small cap stocks that are worth considering in 2019. Before we jump into our list, let me just introduce to our new users who Stock Investing 360 is, what we do. Stock Investing 360 has been founded in 2017. We have a website, stockinvesting360.com. We provide the information on stock markets, investing opportunities, and ideas to our readers and our users, our members. We are targeting an audience made up of individual long-term investors. We're not too much into day trading or technical analysis or get rich fast kind of scheme. We think that investing on the stock market, the way to succeed is to find solid companies that will generate value for its shareholders over time. And you invest on these companies and you want to hold on to them for many, many years. So our investing criteria, we invest on or we look at companies that are profitable, so that are generating profits. We try to stay away from speculative financial assets or companies that are losing money but could potentially make money next year or in 5 years. We prefer to look at companies that have already proven they are profitable. So we look at income statements. We look at the balance sheet to make sure the company is financially healthy. We try to stay away from companies that are heavily in debt. We also look at momentum. Is a company growing its sales and its profit or not? Or maybe the sales are flat or the profits are decreasing. Again, what will help the stock price to go up? It's growing profit, and what will fuel growing profit will often be growing sales. So we look at income statements to look for momentum. We look at valuation. We don't want to invest on a stock that is overvalued. So we look at ratios, price earnings growth, and we also conduct discounted cash flow models. We also take into account market sentiment. So what do an analyst think of a stock? Normally, by experience, when a stock has a positive market sentiment, it will do better on the market than stocks for which analysts are bearish or may put in doubt the management of a company or its business model. So on our website, I invite you to visit stockinvesting360.com. We have a free blog with market review, stock picks and reports, investing strategies. We post between twice and four times a month. So feel free to visit us and use what we provide to our readers in terms of free stuff. And we're selling memberships, 1 month, 3 months, and 1 year membership, and the members will have access to our members area. We have a private blog. We have our stock reports that we only provide reports of stock we believe are interesting investing opportunities for long-term investors. So we concentrate on these companies. We have our stock investing 360 portfolio made up of 18 to 20 stocks that we try to beat the market with that portfolio, stocks that meet our investing criteria. We also have a watch list, a stock watch list. And in 2019, we're introducing two new products: our Stock Investing 360 Small Cap Index, which will be completed by the end of winter, so by March 2019. So we'll be providing small cap stocks every now and then to our members, and we'll build a portfolio with the intent of beating again the market. So do better than the Dow Jones, the S&P 500, and the TSX, because we are interested in companies in the US but also in Canada, because there are some good companies on both sides of the border. And we are also going to build our Stock Investing 360 dividend index made up of companies that are paying above average dividend and that also have some upsides in terms of the stock price. So this will be also made available to our members in 2019. So join us. I think we're charging a fair fee for the amount of work we put in, and I believe that we can help out some small individual long-term investors that do not exactly know on which company to invest, so we provide an extensive list of solid stocks that are worth considering. So let's not talk about our small cap stocks for 2019. So basically, when we decide to take a look at a small cap stock, first of all, the market cap need to be below $2 billion. That's the definition of a small cap company. We want to make sure that the company has an expected growth the next 5 years of above 15% per year. So we look at what analysts thinks of a company. We look at the income statement to make sure that the company has momentum on its side, so basically growing sales and net income. We look at the balance sheet, need to be financially healthy, needs to have debt under control. We try to stay away from companies that has a price earnings ratio above 25, knowing that normally the market average is 20, so we're ready to pay a premium if the growth potential is there, but we try to stay away from stocks with that PE ratio really high. Uh, above 30, that could be something we try to stay away from. And also market sentiment. When available, small caps are sometimes under reviewed by analysts, so we try to have companies that have a positive market sentiment, so analysts with a positive view of the company. So now let's take a look at our first stock of our 5 stock list for today. NetSol Technologies, NTWK. So it's a company involved in designing, exporting software, and selling license fees. So price earnings ratio below 13. That's okay. That's pretty good. Company is profitable. We'll take a look at the net income here. So this year, 2018 was a record year for the company. It generates $4.31 million in profit. Sales have been going up, even though flattening a bit here. But as we will take a look later, the company seems to be in line with a solid 2019. So 2019 could be better than 2018 and 2017. So in terms of profitability, the company is profitable. It's a very small cap, a market cap here. So it's a micro cap in that case. Um, and so let's take a look at its balance sheet. So the company has $22 million in cash, and it basically has a $23 million of total current liability. So a little less short-term current asset than current liabilities. However, I would not be too concerned here because we see the trend. The company is getting close to have more cash than short-term debt. And as we will see, it has signed a few deals recently that will allow the company to have some revenues and profits in the next few years. So it's borderline acceptable, but I would not be too concerned right now. However, I would keep an eye on NetSol's balance sheet for the next quarters to make sure that the company is in line with managing its debt. So the company has some positive aspects. It has a presence in China. So China, even though we hear the news that the economy is slowing down, it's still the second largest economy in the world. So being a small cap stocks in China, I think that's positive. It recently signed a 5-year contract valued $30 million in Europe. That was announced on their latest press release. Also signed a multi-million dollar agreement with an American automaker. So that also was announced during the last press release. The amount was not provided, but you know it's still positive. And basically, the company seems to be on a roll, and the basically the management outlook is that they should build on their record 2018 going into 2019. So that would be that should be positive for the stock price. Uh, Things to consider. We talked about the financial health. It's not a concern, but we should keep an eye on this. Also, slowing economy, like every single stock, we should consider this. Will slowing economy, mostly in China, affect NetSol? If it would be a huge company that have to grow its business from billions of dollars of sales. That could be a concern, but a small company like NetSol, I think that there's plenty of opportunities for a less than $100 million market cap company to grow in China. And we also talk about the company must manage its operating cost. If we just go back here, we see that here the difference between 2017 and 2018, it's not necessarily growing sales, but reduction in operating cost. So company is going to have to manage its cost to remain profitable. So we'll have to keep an eye on this. But in terms of small cap stock, Netsol seems to have the win in sales and could be an interesting option for long term investors. Pick number two now, we change industry. So Callon Petroleum Company, CPE, it's an oil and natural gas producer. Price earnings below 10, so that's way below our threshold of 25 that we want to stay away from. Company is profitable. You can see the net income here. Most 2017 was a record year, and we can see the sales and the revenues really popped between 2016 and 2017, and 2018 seems to be building on 2017. So that's good. One might say that maybe the best time to invest in the company was in 2016. Obviously, that could have been a good move, but we'll see that the company, you know, has what it takes to probably keep increasing its revenues and also its profitability in 2019 and beyond. If we look at the balance sheet, the company has more debt than total cash. However, we've seen how profitable it is. So one of the reasons why cash and short-term cash has reduced greatly from 2016 to 2017 is that the company went on to acquire some new properties in Texas, most notably. So obviously it used some of its cash to finance the acquisitions. But because the company is profitable and quite a lot, I would not be too concerned right now about the financial health. However, that's one thing to take a look at in the next few quarters, how current asset will grow against current liabilities. If we look at shareholders' equity, it grew quite a lot between 2013 and 2016, and again in 2017. So the company is currently generating value for its shareholder. Now, if we look at market sentiment, most analysts are bullish, and there is quite a nice upsides in terms of current stock price and the average target in the next 12 months from the analysts that are tracking the company. Positive aspects, adding wells to increase production output. So between 2017 and 2018, the company increased its output by adding some wells. So it's growing its top line. Basically, it has a diversified revenue stream, even though 70% of its revenues come from oil. It also has natural gas. 3% of its revenues of its business comes from natural gas. So that's interesting if you don't want to rely only on one product. Company is actively acquiring new properties. It recently announced on its press release that it acquired properties in the Midland and Delaware Basin. So company is gearing up to grow its revenues in the next 5-10 years. So that's good. And if we look at the analyst expectations for the company could grow 29% this year and an average of 54% over the next 5 years. Obviously, I mean, 54% is amazing. Will it achieve that? We'll have to see. But still, this is why analysts are bullish on the company. And, obviously, one other opportunity I would say for this stock is oil price. And we'll talk about it right here. It depends on oil price. Right now, oil price have been quite low, not necessarily historical lows, but it could go up, could remain the same. But the company is profitable at the current oil price. So any boost of oil price in the next few years will obviously greatly improve the company's profitability. Again, like I said, recent acquisitions has weakened the balance sheet. We'll have to see. We'll have to keep an eye on this to see how management goes with this fact. And we're not necessarily at Stock Investing 360. We're not too much into natural resources because it's cyclical. So you don't, it will depend on the economy and the natural resource price. But this company is profitable at the current oil price and natural gas price, which are could be higher in the next few years. So that's I think that's an opportunity here. It could go down too, but could go up. So we feel comfortable that Calon has a decent upside to this company in the next few years. Now, pick number three, Camtech. So it's a company that provides services to the semiconductors industry. So that the semiconductors industry has taken a hit the last 6 months because of slowing sales of smartphones and all that stuff. But there's still the 5G technology that's coming in 2019, 2020. 2020, sorry about that. So that company could bank on this. Uh, Basically, sales and revenues are flat, but the 2017 has been a good year. 2018 seems to be on track to match 2017, and profits too were a record in 2017. So again, that investing opportunity could be interesting if Camtech can actually um, increase its offering to semiconductors providers that are going to be involved in the 5G technology. The company's balance sheet is solid, $44 million in cash, uh, $28 million in current liabilities. So it more than covers its next year liabilities from its cash position. Stockholders' equity has grown from 62 million to 84 million. So the company's generating book value to the investors, the shareholders. So that's good to know. Now, if we look at the positive aspects of the company, like I said, a record 2017 and potentially a record 2018 on the way. The 5G network could boost the company's business opportunities. It remains to be seen if the management of the company will be able to take profit out of this opportunity here. Um, Profit margin close to 20%, so that's pretty good. Analysts believe there's only two analysts here, so we need to take this with a grain of salt. But the company is expected to grow by 15% per year in the next 5 years, so that's above market performance. And it also provides a 8.24% dividend. So don't necessarily invest on that company only for dividend, but that's that's a bonus here. Uh, Two analysts out of two believe it's a buy, and it does have a almost 50% upside if we look at the average price, target price for this stock in 12 months from the two analysts that are tracking Camtech. Again, considerations: the semiconductor industry has been under pressure lately, so we have to keep an eye on this. And revenue and net income have been up and down, so we'd like to see a clear momentum. In that case, we've seen that sales seem to be flattening a bit. Net income have been up, sometimes negative, but 2017 and 2018 seems to be on track to be record years. So I would say that momentum seems to be on the side of Camtech in that case. Now let's take a look at our pick number four, Biospecifics Technologies, BSTC. So it's a biopharmaceutical company, provides collagen injections. So price earnings ratio above our threshold, but I think company could be worth the risk here. It has it's not a micro company. It has it's not a micro cap. It has a below $500 million market cap, but still a small company. The revenues have been going up between 2013 and 2017. flattening a bit here between 2016 and 2017. Profit have been flattening a bit, but as we will see here, well, let's take a look at the balance sheet first. So the company has plenty of cash to pay for its liabilities. It doesn't have much liability, so it has a strong balance sheet. There's no risk here that the company will go bankrupt shortly. It has been creating plenty of book value for its shareholders. So in terms of financial health, BSTC is solid. And so basically, what to look for: growing sales and net income, even though flattening a bit in the last 2 years. On its latest press release, the company has been providing information that its star product, which is the Xia Flex, it's an injection, a collagen injection product, has been driving the sales up. So it's been doing well. So we could expect that this will be a main driver in next few years. Company has been working on developing new products. So any biotech company or pharma company must build its pipeline of products. So the company is doing so, and has enough cash coming in to pay for its R&D. So that's also positive. Um, like I said, BSTC has seems to have one star product. It's Xia Flex, so could bank on this product for the next few years. But if we want to see the stock to take off in the next 5-10 years, we will hope that some of its products currently in development will be able to make it to the market, and that could be really beneficial to the stock shareholders. Only one, unfortunately, only one analyst tracking the company, but he's bullish, and he's really bullish because he believes that the stock may have 33% upside in the next 12 months. Again, only one analyst, so we have to be cautious. I prefer when there's plenty of analysts and we see that they're all bullish, but in that case, there's only one, but he seems to be, he has a positive view of the company. So that's also an interesting pick for 2019. Finally, my fifth pick here, we go into Canada, Stingray. So it's a business-to-business music and video platform. Company has been growing through acquisitions. Um, it also has a high price earnings ratio, above our threshold of 25. But the company seems to have potentially, I would say, undervalued. If we and I'll talk about this on the third slide of that the presentation of Stingray. So if we look at revenues, they've been going up. This year seems to be a record year in terms of net income. While the company has been acquiring new companies, so obviously it takes some time to find the synergies to maximize the profitability of the acquired companies. So right now it's digesting a few acquisitions here, but 2018 was a transition year for the company, so it's on track to get back to its 2016 2017 um, standards. And again, like I said, once the synergies will be found and the acquisitions will be maximized in terms of profitability, we should see profit go up, and that should greatly help reduce price to earnings. So right now the stock is selling at a premium, most probably because of what I just said. Um, if we look at its balance sheet, company has a tricky balance sheet here. It has less current assets than current liabilities. Again, it's because of acquisitions. So we'll have to see, 2019, how the company goes with, will it go again for acquisitions to grow its business, or it's going to work on creating synergies to improve its profitability? I hope it's going to be the that option that will be picked. So right now, balance sheet is not strong, but it's not necessarily a concern right now. It needs to be considered though if you want to invest on Stingray. And finally, if we just take a look at, well, analysts are kind of bullish, even though there's only three analysts tracking the company. We we still are waiting their January sentiment on the company. It does have here a potential upside. And one thing that I want to say here is that the company recently bought a Canadian company, and the the owner of that company decided to purchase shares from Stingray at a price of $10.29 a share. And basically, what they said is that they believe that could be the fair value of the company. So it kind of meets the average target price of the analyst. So there's, like 30% plus upside on the stock price potentially for this year. 11.4% is owned by the CEO. So, like, we like to see management to be involved in the company and has the same uh, uh, objectives as shareholders is to grow the stock price. So when the CEO owns more than 10% of the company, he's committed to that. Again, consideration mergers and acquisitions, so that requires funds. So that's why maybe the balance sheet is a bit weak right now, and it also require efficient management. So right now, it seems like Stingray have been able to acquire companies and put their profitability to increase the company's performance. But it's the more the company is growing, the more difficult it will be, and we'll need to make sure that the upper management is efficient enough to be able to generate the synergies in order to grow the company in the next 5-10 years. So, next step for us is to complete our stock investing 360 small cap stock watch list. We want to have between 25 and 30 stocks. We just reviewed 5 of them. They will end up on our stock list, but on our watch list, but maybe not on our index. We want to find other companies. We already have a list of companies we will be looking at in the next few weeks. We will be providing this to our members. Also, we'll share a few picks on our free blog, so keep an eye on this. And our goal is to assemble our stock investing 360 small cap index that will be made up of about half the stocks that we'll have on the watch list, so maybe 10 to 12 stocks, and we will monitor that index against the performance of the Dow Jones, the S&P 500, and the TSX. Our goal is to obviously provide above market performance to our members and investing ideas and opportunities to our members. So just as a disclaimer, I do own shares of Stingray personally. In terms of the 4 other picks, they are now on my watch list and on Stock Investing 360 watch list. We will keep an eye on these stocks. We'll complete a better analysis of the stocks, and they will end up on our watch list, but maybe not on Stock Investing 360 small cap. We don't know yet. However, they could be um, good options for us and to investors looking for potential above market return in the next 4 or 5 years by investing on small caps that do have potential growth ahead. So we hope you enjoyed. Keep an eye on the next video I'll be producing in the next few days. It's going to be our top 5 picks, or maybe not top 5 picks, but 5 picks that we believe could be interesting investing opportunities, and they will not be small caps or dividend stocks. They will be stocks we like, some large cap, some mid cap, and this video will be up shortly. Have a good day. Bye.